Hey everybody, this is Paul. Doing another quick little video here. Excuse my voice, I got a little sick. Just doing a quick update, kind of what I think about the market, how I've been doing this week, and just pretty much where we're at. So, if we look at my portfolio, I've roughly gone up about 100 or so in a week. Um, as the market has kind of been jumping around, for the most part, I've been basically maintaining where the market was. It started negative at the beginning of the month. The market itself did, and I was positive for the most part. This 40-60 approach that I currently have, 40% stocks, 60% bonds going into year end. Um, it has mostly worked. It on the days when the market is down, I'm normally up by a little bit, and when the days when the market's really up, I'm normally right there, a little bit below where the gain is. So if the market's up 0.6%, I'm up 0.3%, or 0.03%. But just kind of looking at how I did over the past week, and just different moves that I've made. Um, I have moved some more exposure into the market. It is pretty clear to me that the Fed is embracing. So the Fed is not acting like the Fed has always acted. So way long ago, the Fed was always kind of late to the party, as they said. So as conditions started to get very tight in the credit markets, the Fed and as government debt went up, the Fed would just kind of sit there, and once the liquidity dried up, and once all the private money dried up and all the foreign money dried up, all of a sudden the Fed would show up, start lowering rates, and be like, "Hey, we're here. Let's save the day." And it would be too late by then. You would get a self-reinforcing crisis at that point. Um, Now, this could go in the opposite direction, where the Fed could make where the market could want to correct itself by what would end up being 5% and end up being 20% because the Fed pumped so much money into it. And that's where I'm kind of concerned right now. Um, Going into 2020, I think it's all going to be based on the consumer, but there's definitely some very underlying issues that I think you're going to start to hear a lot more about in 2020. So what I did this week, so really I didn't invest no new money because it's the end of the year for me, so I got to pay taxes and whatnot on my house. But so what I did is I pulled money out of USFR. This is basically just a 2 year tracking ETR or mutual fund or ETF. I'm sorry. Um, if you ever have like just a stupid amount of money, just $10,000, whatever, and you're just like, I want to stick it somewhere. I don't know where I want to stick it. I just want to stick it in something that doesn't move. This is your stock, or this is your ETF. It mostly stays between 25.03 and 25.08. I mean, this thing is solid, and it basically is all AAA, and it just tracks the mark. It just tracks the 2 year, so it moves around. So what I did is I had about 2 grand in here. I moved it out. There is one stock that I have been tracking, or one ETF that I have been tracking. It's called LTC. It means long term care. Joseph Carlson kind of turned me onto this one. But at the time that he had it in his portfolio, it was down already 5%. And then, so I added it to my watch list, and I saw it drop about 15%. So I was like, thinking that it had finally come into a spot where I thought, yeah, let's kind of jump into this one. So I jumped into that one on about. I have a Twitter where I just kind of, if I'm making a new position, I just started doing updates there. So I threw money into it. Um, Pretty easy. That I made, I made some, quick cash on it. I'll probably end up holding this one no matter what, because I think I bought it at a pretty solid price. Um, so I think that's going to be looking good. Um, and then I haven't really moved anything around at all. I still have very minimal exposure to big name stocks. One stock that that yeah, Johnson and Johnson. Let's talk about that. So originally, I bought just a few shares at 130, and then it has just zipped higher. I think the market has pretty much decided that the thing with the talc powder, the thing that they got going on there, is not going to be that big of a deal for this stock, and that it is just going to keep ripping higher. And it's also just a major, just safe dividend stock. So people have definitely jumped back into that. Um, Another very interesting thing, and this has only happened ever since the Saudis came to the market with Saudi Aramco, and then also ever since just basically December 1st. So one of the ones that has been a really big loser for a lot of people going into year end was energy, just anything energy related. Um, they have massive returns on dividends, but if you've owned an energy stock, you're hurting, and that is really starting to turn around year end. Really starting to turn around. So throughout the year, I've had exposure to energy. So ENBL is an energy company. It's called Enable, and they're very cheap, very high dividend. And I bought them at $13. I put about $8,000. I put a huge amount just into it real quick just to see if I can get it. Um, Wrote it up to 1450, and then or something right around 1450, and then I kind of, if you look at the charts of these things, they really jump around. So I tried to time it when I thought it was going to drop, and I did time it pretty good. I could have wrote it up a little more, but I did time it pretty good. So I made about $700 actually in about a week on that. And then I sold completely out of it. And then I wasn't expecting energy to get nearly as weak as it did. So I kind of sold out of it. I had MLPX. This is my exposure to the energy sector at the moment. I don't have like single names like Exxon or Chevron or whatever. Those are good buys if you're a dividend investor. Just not my thing. I'll probably, maybe someday I might get into those. And then so what I did is going into December, this for me, and I only had like one share in here. This was actually like -5%. Like this was the price on this had gotten down into the tens. I mean, it has been incredible watching the energy swing. So one of the things that I've definitely been watching is where energy is going, and that it tracks oil. So it's basically, it's very weird how it works. So you have a lot of shale companies that will get, and it's weird how a lot of these companies get rolled into these ETFs, and people will just sell the ETF, and you can just kind of guarantee see that's what's going on. So they'll just sell the XLE or something like that, which is the very big one that tracks energy. And even if some of these companies just really barely get any profits from oil, they just get hammered because they're rolled into these ETFs where all the money's coming from. And that's kind of what I believe Michael Burry was talking about, is that there's a chance that, you could have a company that gets 99% or like 95% of their profits from that natural gas and only 5% from oil. But because oil is jumping all over the place, all of a sudden that company's stock price is just getting slammed, even though the price of natural gas isn't moving at all. Um, you had some very old school stock players are just kind of very like, oh my God, how to operate in this new market of ETFs, driving everything. It's just something you have to remember is just always in the background. Um, so moving money out of USFR right here and moving money over to LTC, increase my estimated dividends. Right now it says 1,300. That's because it's doing a bad calculation. Because LTC paid out a little extra. Or where is it at? Yeah, LTC paid out, or no, BNDX. Sorry, this is the international bond one. They have this one-time payment that's actually higher in December than it is in the rest of the year. So E-Trade extrapolates that number, so you get this 135 the whole time. It's not that high. I wish it was that high. That would be amazing. So that's why I actually keep a spreadsheet. Right now, my yearly dividend is 991.12. Still 600 of that is basically tax free, and this is just how I've been doing. 0.19% change is $45 for me. Some other people with very big numbers are doing much better. Here's my gains and losses for the year, actually, for anybody's. Where's my, sorry, performance and value, sorry. So that's my performance and value for the year. So going into 2018, or from 2018 to 2019, I was extremely defensive. So that massive drop, and in my last video I kind of went over this, but that massive drop that happened at the end of December in this area right here, I barely got affected by that. So this is where I'm tracking at right now. If you compare it to the S&P, 28%, right? You're like, oh my God, the S&P is through the freaking roof. And if I go back here, the S&P lost 13% in Q4. So the only way that you're up 28% on the S&P this year is if you weren't invested in the S&P in Q4 of 2018. So what I normally do is with this number, and that's what I went over in my last video, is basically when you hear a lot of people saying year to date, not year over year, that kind of thing. But that negative 13% is why a lot of people are very, very still defensive. All that, no matter what 2018 has done or 2019 has done, people have stayed defensive because that hurt. A lot of people were very heavily exposed when the market just decided to dip because the Fed started to get close to what's called nominal. And that is when basically it becomes more expensive to borrow money than it is to make it back. So there's a few things going underneath the market that I wanted to get out of the way real fast and just kind of put my 2 cents in on this. So you have your portfolio, you have your stocks doing your things here. Your different international exposure, here's an international one, high yield, here's different, you have your stocks doing their thing. On the back end, you have bonds. So I guess I'll go over this real fast just to give a general idea of what drives different things in the market. So E-Trade does have this. A lot of investment portfolios have this. I just like how they display it. If you follow somebody like Lisa Abramovich with Bloomberg or Mohamed El-Erian, they're looking at the high yield market because a lot of people are really, really focused on that high yield market as to where, okay, we think this is where the next crash is coming from. Because companies have taken out over $10 trillion worth of debt in the last 10 years. And at some point, they're going to have to pay that back. And all these weird moves that the Fed is doing, they're responding to what's going on. Kind of like you could see it last year when the rate started to get close to nominal. The HYG fell off a cliff. It fell close to 15%, like it was nothing. And that tells a lot of people that a lot of companies, if they start to get downgrades, it won't take very long before these companies, what they call the zombie companies, Frontier is an example of that, where it won't take very long before the price that they have to pay on their debt is just more than they're able to handle. So they will have to start doing layoffs. And that's what the bondholders would expect, because the bondholders are going to want their money. The investors are going to want their money. Well, guess what? It means cutting employees to cover the cost. So what a lot of people were talking about last week, under the surface, and if you've ever, like I said last week in my other videos, you hear a lot of analysts saying, we're moving up in the credit quality spectrum. We're moving up in the credit quality spectrum. That's because a lot of them were exposed to this high yield stuff when December happened. And when the Fed started raising rates and started to get to nominal, this moving target of a thing, this amorphous thing that doesn't really, it exists, but it doesn't exist. And it depends on the day what it is. But once they started to get close to that, a lot of these companies that were in this high yield thing, where you're supposed to get this great, these high debt companies, they got hit hard. So they're all like, well, we're moving up in the credit quality spectrum. What does that visually mean to a person who is kind of listening to this and doesn't know what's going on in the background. What this means is that companies are trying to reduce their debt loads so that places like Moody's and Fitch and all them will give them this right here. This is the gold standard, or not the gold standard, God no, but this is the standard right now where a lot of companies want to be at in the BBB range. And basically, what triple B means is basically it's just a short way of saying that the ratings agencies have looked at these companies, and all of this stuff is public now. It's very public considering how it was in 2008. You can see where they came out with their decisions at. If you go to Moody's, they publish literally every one of these, the very in-depth analysis, because they took a lot of crap from 2008 for people buying ratings. But if you think they're lying about a rating that they just gave a company, feel free to go look at it and see where they came up with it. And basically, triple B basically means is like, if a recession hits, they're not going to get downgraded immediately, but they could be if they don't make moves to maintain that triple B. So what that means is laying off employees. It means that these companies have looked at them and said, yeah, you have a lot of employees that you could lay off 10% of your workforce and still be a profitable company. So, or you could sell this division in a recession, that type of thing. So they do these recession analysis. That's where they come up with these. The problem is that a lot of companies have moved into this triple B range. So you have your high yield. Let me go back. Sorry. So these are the yields. And if you kind of take a look at what's going on, there was a lot of articles last week that basically said triple B and double B yields are starting to invert. And what that means is basically you're able to get a better yield on a triple B company, which is higher in credit quality, supposedly, and this is what Jeffrey Gundlach is worried about, than a company that's lower in the spectrum. So to a lot of people that doesn't really make sense, because the less risky loan is worth more than the more risky loan. Normally that's not how that's not normally how this works. And it's kind of weird how it works, because if you look at it, this is basically what a lot of people are looking at. I don't believe this has the this doesn't have the name. Sorry. So I mean, that's basically kind of what's going on. So I can just kind of give you a visual, just a layman's visual of this. I don't have the BB one on here that shows it, but basically what's going on is you have a lot of crowding into this BBB range, and you don't have a lot of companies issuing debt in this area. If you look at the number of companies, 394 in the A range, 525 in the triple B range, and then in the high yield range, it's 190. Last week when I looked at this, so it's a Sunday, so they issue more debt. CFOs do this. But last Sunday when I looked at this was 525 or something or it was close to 600. And then in the high yield corporate range, it was like 1. Frontier had one thing right here in the 3-month range that was 11%. And you can quickly understand why they're a penny stock these days. Somebody actually went in there and bought that debt. That used to be right here, and that's gone. If you look at the yield on these, so the yield's right here. So, and the way that these work is basically, so you buy them in bulk. It's basically how they work, and they're basically just bonds. You have to be really good at bonds. Let's put it like that. And this is actually in the BB range. Actually, if you look at it, BB minus and BB. So what somebody like Gundlach's worried about, and it's a very legitimate concern, is okay, you have a lot of companies piled right into this little area. if consumer confidence starts to fall, all of a sudden, these companies right here, instead of me being able to offer my debt at 1.8%, all of a sudden I have to pay up 3.2% into a company that is. And you remember, the Fed didn't really have to go that high with their rates for the market to flip hard, like very badly, like take a huge drop. So what Gunlock is worried about is all these companies that are issuing debt in this area right here, especially this area right here. You start to see drops from here. But these companies, the BBB, is where he thinks something really bad could happen if we hit a recession. And if you look at the companies that are piled into this BBB area, so if I go to like say, and a lot of them are trying to get their debt this far out right here. A lot of them are really trying to secure their debt at least 3, 5, as far out as possible at these current rates, because they're really worried about where this market's going. So if I look at say, so there's a really big difference between being able to issue your debt at 2.668% versus 5.6% if you get a downgrade. And that's why everybody's looking at the credit agencies going, come on, guys. But the credit agencies are looking at it saying, well, we are giving them these rates because if a recession hits, they can lay off 10% of their workforce. So you have to keep that in the back of your head on whenever you're looking at why things are doing what they're doing. So this is just kind of a list of companies that's in that BBB range, the triple B range there, and what's going on. When you have a lot of people that have said this is a debt driven stock buyback market, and yeah, they're right. If you look at the amount of shares available on the market right now versus actual earnings, you can tell kind of what's going on is that a lot of companies have to prop up their stock price. They're basically buying back their stock. And what that means is making less shares available, so the earnings per share looks higher. So you get a higher valuation, so a higher PE ratio, profits to earnings. So I think that's kind of where I'm at right now. I think I'm in a relatively comfortable place. What I'm waiting for is I think the market is going to zip into January, unless there's just because Brexit, that kind of those events aren't until January 31st. The Fed has basically said they are going to buy a ridiculous amount of debt that's being issued. So the government is issuing some obscene amount, like I think the new number is going to end up being 1.4 trillion. It's at $1 trillion now, which is obscene. But the Fed has already said they're going to buy 60% of that debt, which is $600 billion worth of buyback, or worth of buying the government's debt. But just remember, it's not QE, guys. Once they say that program's going to stop, yeah, I'm kind of worried about what the market's going to do. I can easily see the market taking a 5 or 10% correction. If consumer confidence maintains, and I was just at the mall the other day and that place was packed. So if there's a recession coming, it's going to surprise a lot of people. But yeah, that's the two events that I'm looking forward to. Later on to the year, it's obviously going to be things like the who gets the Democratic nomination. Is it somebody that's kind of status quo? If the market gets somebody like Biden, they know what they're getting because they know what they got with Obama. It's not going to be too much interventionist policies. He can say he wants to raise corporate taxes. You would need that's when you get into things like you would need a majority in the Senate, a majority in the House, and you would need a majority of Democrats to actually agree on something. You would need a majority of Republicans to actually, help, or you need Republicans to help. So that's really the political part of it. That's towards the back end of the year. If Trump gets elected, you know what you're going to get. Yeah, you know what you're going to get there. And the market knows what they're going to get. The market is currently predicting a Trump win, or there's some people are making bets on a Trump win. So that's just kind of my 2 cents. Let me know if you disagree. Yeah, if I'm investing horribly, if you think I'm an idiot, let me know. Feel free in the comments. I'm always open to any kind of feedback. This is just kind of how I've been doing. And just remember, like I said, I do things a little bit different. Um, like I said, I like to, these are my capital gains right here. Um, what I like to do is, so if I see a stock, so right now, like for example, if I see a stock, like say if I own 10 of this right now, it was up 12%, I'd probably sell 5 of them and reinvest it in something else lower down here. I would take the capital gains and then also drop it down here because this isn't going to pay a dividend again until, it just paid its dividend. So it'll be another 3 months. Okay. So sell those 5 stocks, drop it into LTC or something like that, or drop it into Disney, drop it into something that's about to pay a dividend, ride that out, and then maybe come back over here once this corrects down a little bit. I'm hoping Johnson and Johnson corrects. I'm hoping it cracks down to 130. That would be amazing. There would have to be some kind of legal news or whatever for that to happen. It's possible. From 146, it's had a great run. It's since October 28th when I jumped into it. It's had a pretty great run. It's probably going to even have more of a great run because a lot of people are expecting 150 or 156. It drops down at this price. If it drops to 140, I would probably sell more of USFR. I'd probably sell BNDX. I'd probably sell some of that. There's a few things that I could sell right away to jump back into Johnson Johnson pretty heavily. If this went back down to 140, well, I'll just kind of keep watching that just to see how I feel about it. So like I said, those are my final thoughts. If you have any questions, just let me know, or if you want to know my line of thinking, feel free to post any comments. Thank you. Bye.